oota, aga ma ei jää siia istuma ju. Ma ei jää siia istuma. Kas siit on kuulda? Okay. All right. Hello everyone on Zoom. So people are here slowly gathering, and we're about to have our second speaker coming up, who is going to be Artur Schaback. And we're still continuing on DeFi and yield farming. Ma lülitasin teise välja. So we're having some technical difficulties, but everything should be good already by now. So get into seats and stay tuned for Artur.
I believe it's very interesting what he has to say. So,
all right, stay tuned.
Well, it became something interesting, right? You hear me? No? I see. Okay. Hey, what's up? Who sold their uni tokens, or who got their uni tokens today? Nice. That's why the gas fees went up.
Yes, thank you for that.
Yeah, so I'm going to talk about DeFi in general, and then the current state and yield farming strategies and my story of yield farming. So a previous talk was really good. It was more like a visionary talk, what's possible with the DeFi in the long term. Really awesome presentation. And I was worried in the beginning it's going to be a lot of overlap, but we don't have overlap. And even if it was overlap, since it's going to be online, I would have to repeat everything anyways. So shout out to Kristen Lowe. Why? Because I actually took his slides and incorporated it into my presentation, so he did the half of the work for him, so I have to shout out to him. Thank you, Kristen, for that, if you listen to me. Next slide, please. All right, so next hour, a little bit less, I'm going to talk about DeFi, its state, like what are the strategies you can do in DeFi, like what do you need to do, why it's needed, some stories, something that is happening now in real life, and how DeFi can be applied, what are the risks, how you mitigate, control them, and then you will make your own decision, right, and you'll have fun. So, next slide. Okay, a little bit more about me. I used to be Bitcoin maximalist until recently, because I was making fun of blockchain, like, oh, like you can't use blockchain like everywhere, and Bitcoin is the thing, right? But now I actually start to understand more about smart contracts and this whole DeFi, which is just a DAO or just a bunch of smart contracts interacting with each other. So I see a potential in that. There are a lot of challenges. Still needs to be solved, like pegging real-life assets to synthetic assets on blockchain. But yeah, I'm not going to get into that. Yeah, so started trading Bitcoin 7 years ago, and till now went through multiple bull runs, like 4 of them at least. Started a startup now, which is Paxful. Maybe some of you know. Who knows what is Paxful? Yeah, like 70%, not enough. Okay, so I have to tell to the rest of 30%. So Paxful is a peer-to-peer marketplace for money transfers with anyone, anywhere, anytime in the world. So what it means that anybody can buy Bitcoin with any form of payment, and then anybody else can sell Bitcoin with any form of payment. And thanks to that, the abilities to move money around the world are limitless. So we connect all the payment networks with each other, right? So they're kind of like DeFi, so they start talking with each other thanks to the peer-to-peer network. So we are number 1 by our volume, so we went past local Bitcoins, and we're doing good. We are growing, working with amazing people in our company, but that's not enough. Like, we don't want to be like another local Bitcoins that we become complacent and then you know, somebody will run over us, especially how aggressive the space is now. That's why we need to build an ecosystem. So, and DeFi is part of that. So I'm going to talk about this. And it's, again, it's aligning with our company mission and vision. We give financial freedom to people with the tech and with an easy-to-use product. So, next slide. Okay, some disclaimers. I'm not an expert what I'm going to talk about. Somebody will know more than me for sure, so I'm welcome to discuss, learn from each other, right? So it's kind of, we can discuss with each other here, whatever, somebody knows more stuff, please add. I expect you to understand how Ethereum blockchain works, how MetaMask works, you know, the Web3 wallet, how transactions work. That's basically it, right? And maybe I have some opinions that you may not disagree, like a previous presenter doesn't see a big need for the yield farming, but I see. So yeah, there's going to be things like that. Okay, next slide. All right, so what is DeFi? In short, if Bitcoin is about the payments, right? It's denationalizing the payments, like anybody has access to payments, but the DeFi is anybody has access to finance in a decentralized way. There is an easy onboarding, there is less friction, and it's just a bunch of smart contracts. It's anybody can build it. So let me tell you a story. What's happening now in Africa, in Sierra Leone? I just heard it recently. Every morning a fisherman is taking a loan with a 10% daily interest. So he takes a loan, he goes to get his fish, right? During the day, gets his fish, sells it, and pays back the loan, right? So why he needs the loan is, I don't know, he needs to buy supplies, he needs to rent a boat, gasoline. That's pretty nuts, 10% interest rate. And then he has his ways, like he needs to stand in the line, in the bank. Okay, he can optimize it by sending his relatives to stand there early on, and so on. And that's the habit there. And it's crazy that actually the tech is there for them to get a cheaper loan and just start using the tech. But the problem is that the tech is complicated, and that's one thing. And then the second thing is the products are complicated. Okay, we're working on the easy-to-use products, but then there's a third thing, is the habit of the people. You can't really change the habit overnight. Same with the Bitcoin. People did not start to use Bitcoin like overnight. It took some time, and you know they had to if they get cut out of financial system, they have to use it, right? They get creative, and they just have to use it. They have no choice, like in Venezuela or exporters, importers in Nigeria, because they have simply no other alternatives. But here, the fisherman still has an alternative. So that's why it's about changing the habit. Yeah, so first example of DeFi app maybe was in 2013, the first stablecoin based on BitShares. Right now, how DAI stablecoin works, it's pegged to Ethereum value, and every 6 hours it checks the Ethereum value on the market through Oracle, and then when the value of Ethereum changes, it rebalances the DAI supply, so one DAI is always $1, right? But for example, when the Black Thursday happened in March, the DAI value spiked. It became like $1.20. So there's still, it's trying to balance itself, but there's still some work to do for that. So next slide. Next slide. I'll get to even more interesting stuff. That's for people who don't know about DeFi. Anyway, why so big deal? Basically, in my opinion, it's about the composability, that all this financial, let's call them financial institutions, they start talking with each other by default. Right now, the banks, the APIs are not open with each other. Okay, there's a PSD2 in Europe, right? But it takes time. So by default, they talk to each other, and you can build on top of each other apps, call smart contracts, one another one. So it's pretty cool and amazing once you get this concept. And so the money is more and more money is getting blocked, right? Historically, there was no trust because of the DAO accident, and then when this ecosystem started to evolve, like insurance and all this stuff, so the confidence came back. So we have like what, $8 billion locked already in DeFi, and there's even more Bitcoin locked than in Lightning Network. Again, it's my opinion for the money that people want to make, right? Because in Bitcoin it's about the payments. There's no this incentive structures like in yield farming. Anyway, next slide. All right, so what do we have now? Stable coins, like just said. The first one was BitShares, now it's DAI, now it's USDT, now it's USDC. Decentralized exchanges, I'm going to talk about them more. The borrowing and lending, I'm going to talk about this too. The Compound, MakerDAO, Aave. Synthetic assets, I'm not going to talk about this. Basically, in short, you can buy Tesla stock without KYC onboarding. You don't have to register on Ameritrade or I don't know, wherever. Just go and buy it on the Synthetic's website, and the synthetic asset just follows the Tesla price. So then there's insurance against the smart contract risk and the yield farming. I'm going to talk about that too. Because who wants to make some money here? That's why we're going to talk about yield farming. Next slide. All right, so we have these decentralized exchanges. One is like a traditional exchange with an order book, but in a decentralized way. They have their own ways how to keep the order books. I don't know, through like some master nodes or whatever more things. Then there's this new cool innovation is the liquidity pools, AMM, automated market makers, as like Uniswap balancer curve here on the left. Everybody can now be a market maker, and then you can exchange your assets, right, with each other, the ERC20 tokens. And then as you see, there's a wrap BTC. I'm going to talk about this, how this happens. And then there's your fee and how much you're getting. That's pretty cool. Then there's aggregators like 1inch. So that's what we have now in DeFi about decentralized exchanges. Again, it's evolving at massive speed. 1 month ago, it was a different story. There was no, there were no other things like right now. Mooniswap or SushiSwap, right? So it's this massive. Noodle swap. Pickle. Yeah, it's actually going to be soon. So next slide. Yeah, so that's how people are wrapping their assets into Ethereum blockchain. So it can be in the DeFi ecosystem. Again, in short, you deposit your BTC to Ren project, to wrap BTC. It waits 6 confirmations, so that project becomes a custodial of the actual BTC, and they mint you the token that represents one-to-one value. And you can have some fun in the DeFi world with that. Okay, next slide. All right, so the liquidity pools that I just said, it's a Uniswap. Everybody can be a market maker. You make fees from that. When somebody trades, depends what your liquidity, out of all the liquidity, you're making fees according to that. So, and it's important that anybody who builds something new in the DeFi space, they need to incentivize people to provide the initial liquidity, right? And then we see all these games like, you know, this vampire exchanges like SushiSwap is trying to lure over the liquidity from Uniswap by giving out free tokens. So, and in my opinion, basically, the liquidity providers in the DeFi space are not so loyal customers like customers are loyal on centralized exchanges, because it's just like one transaction to go from one liquidity pool to another liquidity pool just to make more money. So, and then as you see below, Balancer, Synthetics, Ren, Uma, Compound, CRV, Sushi, Kimchi, Pickle, all these vegetables are given by, as a governance tokens by this liquidity pools and decentralized exchanges. Let's go next slide. So, few concepts of AMMs. There's an impermanent loss. I'm not going to try to explain you what it is. I mean, it took me a while, so just see the example here. If you just hodl one asset, it goes up in price a lot faster than if you put a pair of this one asset and another asset, and it does not, so because the other asset does not go so much up in price, it tries to balance itself 50-50 on Uniswap. You get less gains. So always think about this impermanent loss. It happens when you put two assets in the liquidity pool which don't have one-to-one ratio. So if you put like USDC, USDT, or a wrap BTC, rent BTC, there's no loss of, I mean, there's no risk of impermanent loss. So do not get wrecked. That's the moral of the story. Personally, I think I got wrecked with Ampleforth, but then there was one pump, and then I sold it at a really good time. It went to $2, and before it rebased, I sold it, so happy end. Next slide. All right, so lending, borrowing. Showing here what my friend is doing, Stani from Aave. It's a pretty cool thing. That's actually the first concept to yield farming. I'm going to explain that later on. What are the steps and what are you gaining? So you loan some collateral like Ethereum, and then you can borrow something else. And the magic here is that you have to give out more than you can lend. So in real world, if you want to borrow from bank, you can give less collateral than you're borrowing, right? So you give collateral your property, and then you can borrow more than the property costs, let's say so. But here you have to deposit, let's say $1,500 worth of Ethereum, and you can borrow only $1,000 worth of USDC of a stable coin. Because if the Ethereum drops in price less than $1,000, you don't have enough collateral to pay back USDC. So what happens? Liquidation. Your Ethereum gets liquidated, and all this decentralized money makers, they have their liquidation strategy that you can lose like 50% of your Ethereum, 10, 20, whatever the logic is. So you can see here how much my collateral ratio, I can borrow actually 30% more to max out my borrowing. I almost got wrecked. I had this at 99% when everything started to tank about 2 weeks ago. So I was super lucky. I had to, it was a race. It was like a James Bond movie for me. I had to take out from my liquidity from Uniswap, that's one transaction, unstake, second transaction, and then I had to always make the fast fees until I could pay back some of the true USD, so my collateral ratio went back to this normal percentage. Ethereum, I think it went from 450 to 350. So, yeah. And me as a lender, I'm making like, what? Oh, you don't see here, under deposits, I'm making like 1-2% on my Ethereum a year just by lending it, and there's only a smart contract risk. That's it. I was a little bit skeptical before, but now I went all in because YOLO, that's the DeFi space right now. Next slide. All right, let's get to yield farming. That's something I saw first time. I was like, what the hell is this? I'll give some time to read. It makes perfect sense for me. Oh, so who understands what's there? 1, 2, 3, 4, 5, 6. Okay, that's good. So, okay, for everybody else, let's make a crash course. For me, 2 months ago, and even before how my DeFi journey started, I was on a radio interview in spring. Then I talked about peer-to-peer finance, financial freedom, about Bitcoin, about Paxful, like how it's helping people around the world. And then at the end, the guy was like, oh, what do you think about DeFi? Like, what's DeFi? He's like, oh, we actually had, before you last week, some guy from 1inch talking about DeFi. That's the shit, right? Like, okay. And then I started to read about it, but I still didn't get it. And then I set a goal, like, okay, I have this Ethereum that I'm just sitting it on for 2 or 3 years, not making anything. And then I read all these gains, 150%. Like, let me experiment. I'll start playing with that Ethereum, and then in 2 months I'll see how much extra Ethereum I'll gain, because it's not trading, right? In trading, you can lose when you trade. But here, you give your liquidity, there's no risk of losing in trading, there's a risk of impermanent loss, smart contract risk, basically different risks. So, and that's what I recommend. If you want to start getting into that, have some goals. Because I was just reading, I didn't understand for 2 weeks. I met some friends who I know in blockchain. I was like, hey, where's all this money coming from? Where's the 150% coming from? 250, like, what the hell? So then I understood, okay, these are this governance tokens that are being, you have a question?
Well, I can maybe help explain what the smart contract risk and the permanent loss risk is.
It will be soon, yes. First, let's get to the sweet part, then the risks. Yeah. So I was reading about that. Then I met a couple of friends who were into blockchain, and some of them are here. And then we're all together like, okay, this is just these tokens that have value, and then they get listed on centralized exchanges like Binance, and then all this retail is buying up. Then is trading, right? While we are just farming them by giving our liquidity, right? We're helping the project, really sincere intentions. So, yeah, then when I got into and when I started to finally understand, I was up till 6, 7 a.m. and having spreadsheets about my movements and all that. So, really trying to keep it organized. And yes, 2 months I made 15–20% profit. So no trading, quite risk-free, and I still have all these shit tokens that I haven't sold them. I'm big with Meta, M-Stable. Unfortunately, it went down from 10 to $2, whatever. I did break even, and the goal is to learn it so we can implement that in Paxful eventually. So some good stuff is cooking there behind the scenes. Next slide. All right, so let's talk about what we need to do. Recipes. First thing, what I did, I deposited Ethereum to Compound as a collateral. I borrow 75% of the Ethereum value of USDC. Now I'm making Compound token. It's $160 now on exchanges, because I give them my liquidity to Compound project. Now I'm going to M-Stable. I'm minting them USD. It's a 1-to-1 ratio to USDC. I'm putting this MUSD into the balancer exchange. So I'm earning now balancer tokens. I'm earning MTA and the trading fees from the balancer, because there are people also putting here the liquidity, right? And there's kind of this chain reaction. There's this, in balancer, it's not always 50–50% ratio. You can set your own ratio, you can set your own trading fees when you create this pool of two assets. I think this is 5% MUSD, this is 95%. And then imagine this, you mint this MUSD, but you don't have MTA. So in balancer, you can deposit MUSD, MTA gets bought automatically. So, and then it goes up in price. And then the return percentage increases. And then people see that. Next person starts to deposit here because the higher the percentages, automatically this gets bought. That's how it goes up, like a snowball, but reverse. That's crazy, yeah. It still blows my mind. Next thing, that's not all. Wait, there's more. Now you're staking you get this BLT token. That's basically your deposit into the balancer BLT token you can stake into M-Stable projects, so you can earn extra MTA. Why? I'm not sure, but I think it's so. So you lock your MTA, so there is no sell pressure on MTA, right? So it gets more scarce. It's like the centralized startups like Crypto.com is also using that approach. Lock your crypto token for 6 months. You get your debit card for free, you get your cashbacks, whatever. So there's less sell pressure. That's genius. So, and here's some numbers, right? With 100K investment, 75%, 75K a year, $200 daily, $1,500 a week. Risk of impermanent loss. If the MTA price goes down, if it was $1,000, if it was $10, you have there, let's say 1,000 of MTA tokens, and then you have $20. Now it goes up and down in price. Now you have $5. Now you have 2,000 of them in that pool, and you have twice as less dollars. So, I mean, you just have to understand like how this works, because this is a big, big thing. Yeah, any questions about this recipe? The fees are crazy. I paid like, I think when I turned back my MUSD back into USDC, I paid $200. One transaction plus five other transactions, like another $100, so $300. The backwards, right? And then to do this way, it was like $100, and then backwards another $300, so $400 in fees.
So then you take then you convert it to Bitcoin and you go to BitMEX to trade with 10x leverage, right?
That's true. That's gambling, right? I don't do that shit. I keep out of trading.
No, but Bybit is better.
Yeah, you go to Bybit.
I don't do gambling.
So what's the minimum investment you need to do to be break-even?
Just do your math, man. If the fees are like assume $400 of the fees.
So if you go below 10,000, you will not get break-even.
Yes, five digits. Yep. Yeah, so that's pretty nuts, but there's more to that. That's the full Degen zone. It's one of the next slides. Okay, common recipe. Okay, the Bitcoin maximalists who are holding their BTC. I was also like holding BTC for whatever time. I'm like, fuck, let's make some money. So you mint SBTC, I mean, you mint REN BTC or WBTC, you deposit it to Curve. So Curve is also AMM, but it focuses on pairs which have stable pairs with each other. It focuses BTC to BTC, the tokenized BTC to BTC to USD stable coins with each other. And then they're going to add gold, I think. There's some talk about. So you deposit into their SBTC pool your REN BTC. It's a pool of 3 assets: REN BTC, RAD BTC, SBTC. I don't even know what is SBTC, but what supposedly they're. I mean, yeah, they're. Okay, synthetic BTC. Yeah, but look, they keep their 1-to-1 ratio, right? So because you gave your liquidity there, you're earning CRV and the trading fees. So trading fees from everybody else who is also depositing there. And I deposit just REN BTC there, so it buys automatically from the pool SBTC and RAD BTC. So I paid the fees. Somebody who deposited before me got my fees. So now I'm earning the CRV. Now, so in order not to have a sell pressure on CRV, you stake the CRV into their DAO, you get extra CRV. That's awesome. So again, this is not it. I mean, the people behind that are geniuses with all these game mechanics and so on, like how to incentivize people to lock into their platform, all these things. Like, then you have this boost thing. I never seen this boosting in other places. You can get up to 2.5x boost. If you lock up, I think that for 4 years, you get this 2.5 boost. And then there's more complex. It depends who else is locking up this CRV. So you can get up to 2.5x boost, and this is how much you can make, 45% or even more. You can play around there between their different pools, and no risk of impermanent loss, because 1-to-1 ratio of this tokenized BTC. Any questions about this?
Don't get wrecked.
Yeah, well, like, there are different ways I'll tell them, okay. Because it's more or less risk, I mean, it's more risk-free because it's no impermanent loss, right? There's a smart contract risk and, I don't know, Ethereum death risk, gas fees, yeah.
You also have the custodial risk of the Bitcoin.
Exactly, custodial risk, yeah. I think there's some news that some hackers are trying to always hack it, get the private keys for this address that has a lot of this BTC. Next slide, please. Okay, so easy recipe. Yearn. Who knows about Yearn finance? Cool, cool. Personally, I'm really bullish on that. The guy behind this, Andre Krone, is genius. He's been in the DeFi for so many years. So he's the brains behind the project. And the idea of the Yearn is like a hedge fund, right? Like the previous presenter was saying, it's aggregating, it's pulling together all people's funds, and then using that as a single pool to go into like CRV, and then you can get this 2.5x boost and all that because it's pulled together. That's one thing. And the second thing, you save on the gas fees because again, it's pulled together. There's some savings, and then it just goes and kills its copycat like this Definance or IT, 2Is and CRV and Swerve, all that. It just fucking goes and farms the hell out of them. So I think it's an amazing thing. I don't know how long it's going to last, the whole farming, but as long as the farming lasts, that's one. Going to be there. And second is they're building their own products like stable credit, insurance, and all that. So that's the community too. That's why they're moving so fast because it's the community that they're building that in parallel, right? In the centralized organization, it's like more. You gotta like be more organized, but here you just build stuff. So that's a cool project, in my opinion. All the haters, we can talk later about this. Okay, so now some hardcore recipe. This is actually Kristen Lowe, who I mentioned at the beginning, he told about this. So that's how you can do leverage on your collateral. So I mean on your lending. So you can lend more than your collateral because you do multiple iterations of lending. Easy. You have the stable coin. I mean, you get stable coin on Compound or Avi. You deposit to Curve. You get this YCRV token. You deposit YCRV to Yearn to generate YYCRV. So it gets you this CRV. Well, the Yearn actually automatically sells the CRV token and it's giving you back the stable coin. Now, there's this Cream Finance. I don't know what the hell is this, but I tried it. It's amazing. It's just like a copy of Compound, but then you can lend and borrow more this like YCRV assets. So that's this composability and like how easy you can get all this new assets. Like again, without regulations, anything. You just go and create this assets that you can lend and borrow. So point is now this YCRV you can lend it. Now you have another collateral. Now you can borrow, again, stable coins. So you're earning Cream, because Cream is like this Compound token, is the governance token of the Cream Finance. And then you repeat that cycle multiple times, up to 5, whatever you feel like. Because look, if you did the 2 cycles, $1,200 in gas fees and 250% return. If you do more cycles, you can get even more. I personally haven't done it, but that's another hardcore recipe. I don't know if it made any sense, but the idea is that you can do iterations to lend more than your collateral. All right. I'm speechless too, actually, what's possible. Next slide. All right, that's the Degen zone. So who's that guy on the right bottom?
Artur.
From where?
Yes,
this guy is also complete Degen because he's also like researching, and then he wrote this blog post about the DeFi future and so on. But hey, this is what we have. This screenshot I took from CoinGecko. They have this slider to show all these Degen things. So the idea is that, as you see, Pickle Finance, the pair is a Uniswap Pickle and Wrapped Ethereum, 3,000% yearly. Like, how is it? 3,000, that's crazy, but so as you see, you need to buy Pickle before you can participate in that. And then this Pickle basically says, if you participate in this pool, Pickle Wrapped Ethereum compared to Wrapped Ethereum USDC pool, so in Wrapped Ethereum USDC pool, they give you 5 times less Pickle in return. But in that Pickle, I think in sushi, they gave you like 5x more sushi in return. And that's why you buy sushi, so you can get this 5 times X more return, and then everybody buys sushi, and then that percentage grows until collapse happens. We've seen that. I know you call this Ponzi or not. There's definitely some characteristics on that. I keep personally out of that because I just don't want to play these games. I'm just doing this stable yield farming of this like long-lasting projects. Again, impermanent loss, like sushi value drops, right? That's a big thing. I still keep sushi, but I think now that Uni has their own tokens, will just float there at $1. So the smart contract bug, if you remember, there's another game of the rebase game. That was like a month ago. So it is like yam. It's yam, the sweet potato knows who knows yam? Cool. So yeah, they have this rebase every 8 hours that people pull into the pool, they get return of yams, and then the price goes up, and then in 8 hours it either creates or destroys so many yams that the price has to be again $1, right? So it equalizes to $1. So there's this game until it goes up in value, and then the weak hands are selling that before it creates this more yams that's gonna tank the price down, like 10x. If the price went up to $10, then it's gonna create 10 times more yams. So that's like this the Degen zone where all these games are happening on Ethereum smart contract, on Ethereum blockchain. Yeah, and then another risk is the unaudited smart contracts. People like sushi was unaudited, like $700 million locked in there. That's nuts, like in my opinion. And then there's like a pre-mine of this, the sushi was 27 million tokens was just allocated to master chef who could dump it at any moment, crash the market, which he did. So DYOR, do your own research. That's my best advice. Next slide. Yeah, so this is the example of Pickle. 75% of reward. So it didn't say like 5 times more, but it's out of all the pools, it gives you 75%. And this is the return compared to others, right? Who doesn't want this return? But for that, you need to buy Pickle. So. Next slide. Yeah, so where can you spot the opportunities? A few websites. The screenshot was from CoinGecko. You can turn on this Degen, all this vegetable swaps projects are going to be there. Yeah. Next slide. All right, let's talk about the risks. It's actually one of the last slides, so we're almost there. Liquidation risk. That's when you lend, and like I said, if the collateral ratio is good enough, you won't get liquidated, but you can if the price drops too fast, like it happened in March. So how you can mitigate it? You basically monitor the collateral factor, and then you mitigate the risk by restoring the healthier collateral factor. Impermanent loss. The risk is that compared to just holding your asset, you're making less in returns when you put in the pool because the other asset pair doesn't appreciate this much in value, so your link token didn't go up this much in value in the pool rather than just holding by itself. So mitigation, just hold it and don't put them into liquidity pools. Okay, the smart contract risk, there's vulnerabilities, bad faith, some actions from developers. What you can do, audit smart contracts. There are companies that are auditing them. Again, this is not a 100% proof that it's all kosher, everything's working. Again, do your own research. And then you can use insurance. If something happens, there's a decentralized insurance that something happens with a smart contract, you get paid back the money. And then the last one is the biggest, the most hardcore risk, which has the least risk. I mean, the least possibility of happening is, I know, the blockchain gets messed up, something happens with the whole blockchain. So consensus fail or whatever. So you can actually hedge your Ethereum price on Deribit exchange. And remember that any of these mitigations, they incur some costs to you. So your returns a little bit diminished because you have extra costs. Okay, we went through the farming, how to be there safely, what we have to look on. Let's skip next slide. That's it, thank you.
Thank you, Artur.
Yeah, people are going to hear you in Zoom.
What do you think about the governance tokens? Like in the case of earn finance, the distribution happened like an airdrop without an actual price. He said it's worthless, like, there's no price. But in the Uniswap case, there was a price already. So what do you think in terms of regulations? Like, what's going to happen to those government tokens? Are they going to become like obsolete at some point, or it's just going to stay like that forever? And
that's a good question, right? Especially about the IFI token, Yearn Finance, and then Uniswap. Basically, if we to think of in terms of regulation, this DeFi may need its regulatory body. If it's a lending borrowing, then you need to have the lending borrowing. How do you call it? This agreement. Lending borrowing license. Yeah. If it's about insurance, like Nexus Mutual, you need an insurance, right? So it can go as far as that. In terms of these governance tokens, I don't know. Look, they are not using the word issuing and then saying, oh, it has no value and so on. But at the same time, it's get listed on exchange. So who knows? But I did really like the Yearn distribution. There's no this 1 inch where 50% went to founders, investors like Binance Labs, right? And then they just dump these tokens, and investor never loses in this case because they got these tokens at super cheap. Yeah, that's what I think.
Thank you.
Yeah, I just want to add something I think is really important to note about DeFi, and that is that any particular project might fail on it, but since it's also tied together, there's a kind of resiliency to it, because as long as part of the stack is sound and there's no smart contract risk, like you say, or no smart contract exploit, that will survive even if some part of it falls off. So I don't know if you had any comments on that, but I just see that as that's part of the excitement for me, because you might take individual risks, but the class of opportunities is there to stay.
Right. So it's just $8 billion locked compared to the whole financial world. That's nothing. That's why I think it's still a big playground with a bunch of whales. Well, we saw there's only 50,000 users in the whole DeFi space, and we can think of it is a playground of whales, and that's it. To test the grounds, risks are always there. It happened. When this thing is going to collapse again, it's a really good test for all this code in smart contracts, how they're going to be, all this composability will be working against each other. So I'm curious to see how it's going to be developed, and I'm glad I'm part of this movement too.
Is Bitcoin going to be part of that movement as well, or just going to be there?
So is Bitcoin going to be the part of that movement, right? So Bitcoin has layer 2 solution Lightning Network, and there's also smart contracts possibilities. But Bitcoin is meant for payments, and Lightning Network is also meant for payments. All Ethereum is, or whatever, all the smart contract abilities, blockchains are meant for DeFi. Yeah, so somebody said scam, right? But there's a part truth in that too, because there's a lot of this scam projects. But there's a good stuff too, because, and why people are building on Ethereum, because all this ICO craze a few years ago, it has already an ecosystem, it has already some apps in it, right? So why the hell do I have to build on Tron or EOS? There's an ecosystem there, and there's tools there, so there are some really cool projects being built on. Well, I use it, right?
How do you see Ethereum 2.0 in the future?
2.0, I think it's scaling. It's all scaling solutions. That's all I know. That's it.
Hey, Binance wants to go into DeFi space. What do you think about that?
Well, Justin Sun wants to do that too. Yeah. Who doesn't, right? If Binance wants to go, nobody wants to lose. Wants to miss a piece of that action. Like everybody, it's business, right? Like it's future. And they have the resources, their aggressiveness, their culture. They're trying. But again, look, we're thinking of this centralized organization, Binance, against the whole community of Ethereum blockchain. Same with like Yearn community that is building all these apps compared to centralized apps that are building. I think it's the same example.
No? No? No one? Okay. We're good then. No one?
Nobody didn't understand anything.
Okay, you do?
It's more about something you were talking in the beginning about someone in Africa taking a loan and paying like interest daily. So in order for him to take a loan on the DeFi, he has to have money to deposit as a collateral. So how would that work in your opinion in the future? Because he doesn't have the money right now to go to fish, so he takes the loan to have the money to go fishing. So in order for him to take the money out of the DeFi apps, let's say he would have to have money to deposit as a collateral. So how would that work?
That's a great question, because this is the connection between the real world assets and then the DeFi space. So
Exactly.
So that's the fiat on-ramps and off-ramps, and Paxful is actually doing that. So we as Paxful, we are the fiat on-ramp and off-ramp for the whole Bitcoin ecosystem, soon DeFi ecosystem. So once there are easy off-ramps and off-ramps into DeFi and back to your whatever bank account, that's when it's going to work. So the off-ramps and on-ramps need to be built. Thank you.
Thank you very much, Artur. And that's going to be it for today. Thank you, everyone, for coming. You can still stay here, chat with each other, have some beers and non-alcoholic drinks as well. And yeah, thank you again for Martin Bohm and Artur. And I hope really that we're going to see you all next time. Thank you.